Well, welcome everybody. It's great to have you here. My name is Joe Phillips. I am Dean of the Albers School, and it's my pleasure to welcome everybody to the Albers Executive Speaker Series tonight. We're really delighted to have with us Dr. James Barth from Auburn University, and he will be speaking about challenges and opportunities, the 5 to watch in 2023. So let me do a little introduction on Dr. Barth before he comes to the stage. Dr. Barth is the Lowder Eminent Scholar in Finance at Auburn University, a senior fellow at the Milken Institute, and a fellow at the Wharton Financial Institutions Center. His research is focused on financial institutions and capital markets, both domestic and global, with special emphasis on regulatory issues. He has served as a policy advisor for governments around the globe. He was appointed by Presidents Reagan and Bush to be chief economist of the Office of Thrift Supervision, and prior to that to the Federal Home Loan Bank Board. He has testified before U.S. congressional committees on matters of financial policy and authored more than 300 journal articles in professional journals. He has also co-authored or co-edited several books, including The Great Savings and Loan Debacle, Rethinking Bank Regulation Till Angels Govern, and The Rise and Fall of the U.S. Mortgage and Credit Markets, a comprehensive analysis of the meltdown. Dr. Barth has been quoted in publications ranging from the New York Times and Wall Street Journal to Barron's and Newsweek, and he's appeared on various broadcast programs speaking on financial policy. So with this, can you please join me in welcoming Dr. Richard Barth to Seattle University?
Thank you. Thank you very much. Thank you, Dean Phillips, for that introduction. It's a pleasure to be here. I'm going to be relatively informal tonight. My topics are important, but they're not going to be talked about in too complex a manner. Hopefully all of you will be able to follow what I have to say. I'd also like to thank Ben Yao, who's here, one of the faculty members in the School of Management, who's a good friend of mine and worked with me at the Milken Institute. I was talking to one of the gentlemen who's behind us here with one of the cameras, and he was asking me about my talk, and I told him, and I had forgotten that I have the title here, Challenges and Opportunities. It turns out that I once was writing a book, and the gentleman who founded the Milken Institute is a gentleman named Michael Milken. And the Milken Institute is located in Santa Monica, California. And the title of the book was something to do with crisis in the financial industry. And he said, Jim, why do you use the word crisis? I thought it seems relevant for what the content of the book is about. And he said, I really don't like that word crisis, and I'd suggest you don't use it. I listened to him, and I said, well, if it's not a crisis, what would you call it? He said, it's a period of challenges and opportunities. He said, that's the what it's about, right? Your book. I kept the word crisis because I thought it'd sell more copies, which it didn't. But it turns out he's quite right. And so I was talking to Alicia, who's here, and we were talking about the title of my talk. And I said, what about challenges and opportunities? Because that's what we're facing today. Challenges, but there are also opportunities to make things better, perhaps than they are today or they have been in the recent past. So that's really what I'm going to talk about, and I'll say something about 5 different topics. Now, let me start, and at the end, I'll try to answer some of your questions, and any questions that I can't answer, of course, we have the dean here, okay? And he, of course, can provide answers to questions that I cannot answer, but hopefully I can answer some of them. It turns out, here's the 5 topics, which I think we're all interested in. You can see the first, economic growth and inflation. We hear a lot about that today. We heard today the Federal Reserve, and the chairman of the Federal Reserve is a gentleman named Powell. What he indicated, and his colleagues, the Federal Reserve has decided to raise the interest rates again. by 0.75 of a percentage point, or 75 basis points. The fourth time this year. I'll have something to say about that. Not something that's overly complimentary with respect to his performance. And you know, he was first appointed by President Trump, and he was reappointed as chairman of the Federal Reserve by President Biden. And the chairman serves 4 years as chairman of the Fed, otherwise a 14-year term. So I'll talk about economic growth and inflation, which we're all concerned about. Maybe less so on the part of somebody like Elon Musk or Jeff Bezos, people like that. But for most of us, we do care about economic growth and inflation. I'm going to talk about home prices, give you sort of a short view of my assessment of what's going to happen to home prices, what has been happening. And then I'll talk about federal budget deficits and debt, and give you sort of a quick assessment of what's happening with respect to both of those two key macroeconomic variables. I'll move on to talk about cryptocurrencies. I was talking with one of the faculty members here as we were walking over to this lovely building, and he has invested in some cryptocurrencies. I'll say something about perhaps what I think about cryptocurrencies, and we'll see if I'm in line with him, but he's in the back. I won't identify him. I won't tell you whether he's made money or lost money or is likely to lose even more money, okay, and give you a quick assessment if you don't know a lot about cryptocurrencies or blockchain technology. Just give you a snippet of information about how many cryptocurrencies are, how many Bitcoins can be mined over time, when the last one should be mined, and the different participants in the cryptocurrency market, especially with respect to Bitcoin, and a new way in which one actually records and verifies transactions, something new with Ethereum. Then I'll talk about where one grows up and economic outcomes. And that's perhaps the most important topic that I'm going to talk about today, because it has to do with young people, okay, and where they're headed, what they can expect to do with respect to whether or not they're going to earn more than their parents have earned. And most parents want their children to earn more than they have earned in their lifetimes. But there's some information about whether that's likely to happen or not. And we'll see the difference between where I teach in the great state of Alabama, okay? You don't hear that too often, do you? The great state of Alabama? I have to say that, okay? President of my university would be unhappy if he were to see this, and I said, Alabama, okay? Doesn't rank at the top in every category, but some categories, okay? Maybe not the most desirable categories, but some categories, okay? So I'll say a little bit about the Southeast and some news that's not so good, but how we might be able to make some changes for the betterment, not only this country, but other countries as well. And I'll compare a couple countries. And you'll see how some countries use the information I provide and grow their economies to a far greater degree than other similarly situated economies some years in the past, okay? It all has to do with human capital, something that some of you that are students here at Seattle University are doing, building your human capital, the most important asset that we have, and perhaps a somewhat neglected asset to our disadvantage. Okay, economic growth and inflation. Let me start. This basically is health issues. You can see as of early October, there have been more than 6.5 million people that have died because of COVID-19. Not the worst epidemic, but one of the worst in the history of the world. And you can see, go back to 1918. Spanish flu, 50 million people died of the Spanish flu. Now, what's the difference? Think in terms of the population today worldwide versus the population 1918. A large percentage of the world's population, the worst epidemic. But today we've had a problem because of a health situation, not an economic situation, but a health situation. And you can see the different, and I happened to be in Hong Kong during one of the epidemics. I was in also China during Asian flu. Wasn't in Russia during the Russia flu. Missed that one, okay. In the U.S. During, obviously, the pandemic, like the rest of you, I've had a number of shots. It seems like every time I turn around, they say, you need another shot, okay? First, it was just vaccines, then it became boosters, and then it became something to deal with the new variants of the flu, of the COVID. In any event, you can see a lot of people, too many people, and a lot of controversy over did we do the right thing, the wrong thing, so on and so forth. Not my area of expertise per se. So I move on, and you see what happened in 2020, a couple months. Monthly industrial production plummeted, basically. Unemployment claims also took off, okay? And job openings, postings, basically, also jumped. A lot of bad things happened in a short period of time. And in fact, we had then U.S. retail stores were shut down, closed. And look at the change in restaurant occupancy. A lot of people then learned to be able to order out and have things delivered to their homes, to their apartments, to their dorms, those sorts of things. Plummeting. If you had a restaurant, obviously, deep trouble. We had the shutdowns and the lockdowns here in the United States. Still lockdowns to some degree, as you know, if you're from China or you read about China. I used to go to China almost every couple of months. I haven't been to China since 2019, the last time I went. But I used to go there every couple of months, or other parts of the world. I think I've only been on a plane 3 times in the last couple of months. Washington, D.C., here, and to Portland, okay? That's it. But it used to be almost every time I turned around, I was booking a flight to go something, usually out of the country. But those of you from China, or obviously know it's hard to go there without having shutdowns, like being vaccinated, being in a hotel room or something. So this was all due to a health problem. Don't forget, not an economic problem, which is most of what we hear about and what I'm going to talk about. So here's real GDP, cyclical fluctuations. So sometimes real GDP grows at a positive rate, sometimes at a negative rate. Now, the gray areas that you see, those are periods of designated recessions. Now, we know this year, the first 2 quarters, real GDP, that's nominal GDP adjusted for changes in prices, grew at a negative rate. So there's been this debate. Are we in a recession, or were we in a recession the first 2 quarters of 2022, or were we not in a recession? The rule of thumb has always been when real GDP grows at a negative rate 2 successive quarters, we're in a recession. But there's 8 economists associated with the National Bureau of Economic Research, and they identified when a recession begins and when it ends, or whether we've been in a recession. Those 8 economists have not made a decision. It usually takes a year or so to decide. They look at a lot of information. They determine the severity of the downturn in economic activity. They look at how widespread it is, say in the economy like the United States, and also how long it lasts. They have not made a decision, okay, as of today, and they probably won't the remainder of this year. So, rule of thumb, yes, we're in a recession. Technically, no, because these 8 economists haven't told us whether we're in a recession. Now, when it's long over, they may say, yes, you were in a recession, but they don't tell us at the time. So that's why there's that dispute. Now, notice the last recession to the end. There was a tremendous downturn in real GDP. It plummeted, but then there was a sharp rebound. Okay, that was the shortest recession we've ever had in this country. It only lasted 2 months, but it was declared to be a recession by these 8 economists. I'll come back to that. Now, what about consumer prices? I go back in time. In 1980, prices rose almost 20%. Today, they're over 8%. Is the inflation as bad today as then? No, okay, but it was very bad. You could have bought a 30-year Treasury security and gotten close to a 20% interest rate. A billionaire in Texas bought $1 billion worth of 30-year Treasury securities. Every year he was getting, what 20% of $1 billion is? A lot. Yeah, if you don't know the exact answer, always say a lot, okay? That's what I tell my students. You're able to answer the question, and they sometimes know I don't know, and I say yes to just a lot. How many people in the world? A lot, right? And then sometimes you want to be a bit more exact or more specific, okay? So they were very high. Well, we then had a chairman of the Fed, and what did he decide to do? Raise interest rates. He raised interest rates a lot. What happened? It threw the economy into a recession. So what's happening today? Our Federal Reserve, our central bank in the United States, located in Washington, D.C., under Chairman Powell, has decided inflation is too high, over 8%. We have what's called a headline inflation number, 8%. Then we have what's called a core inflation number. You take energy and food prices out, and that's 6%. The Fed's target inflation rate is 2%. See, it's too high, according to the Fed. So they're raising interest rates. The fourth time, 75 basis points, okay? 3/4 of a percentage point. In my view, the Federal Reserve lowered interest rates, lowered them too much, and kept them low too long. They did that in 2002 or so to 2007. And we had a housing boom and a housing bust, okay? Now we had a sort of an asset price boom, bond price boom, you might say. The Fed has raised interest rates now, and what's happening? Asset prices are coming down. Home prices, bond prices, those sorts of things. So the Federal Reserve now, in my view, is raising interest rates too much and too fast. Okay, it made its mistake, lowering rates, okay, stimulating demand, boosting prices, contributing to inflation. Now it's doing the opposite, raising them too much too fast. And the Federal Reserve today, in my view, is making a mistake by raising them too much too fast, made a mistake lowering too much too fast, just as the Federal Reserve did in 2008. So early this year, in January, I was telling my students, I think the Fed's going to have to raise interest rates. We're going to have inflation. And so I decided it was time, though I'm not an investment advisor, to move out of the stock market, which I did, okay, in January. And my student kept saying, Dr. Barth, you said we're going to have more inflation, interest rates, the Fed's going to raise interest rates. Aren't you wrong? And I said, be patient, okay? Another thing, if you make a forecast, make it far into the future and everybody will forget if you're wrong, okay? But I was doing a short-term sort of forecast, and I'm glad I did do what I did, because I thought we're going to have more inflation because of money supply growth, okay, and because of then spending, and maybe too much spending with respect to COVID-19. Should we have spent? Sure. It was a health crisis, not an economic crisis. Was it due to President Biden? Was it due to President Trump? Okay, it was a health crisis that was inevitable, and we can't blame, I think, either president for that. But we can blame the Federal Reserve for what it did, and I'm willing to do so, on record to do so. But the Fed doesn't always call me and say, Jim, what should we do? Okay, and I might say hope and pray, okay, or do something else, but I mean that. The Federal Reserve, though, has not done a particularly good job as distinguishing itself with respect to economic growth and inflation. Now, here's what's bad about inflation. You've heard the phrase, inflation is the cruelest tax of all. Why? In Venezuela, I could identify other countries, not too long ago, we had tremendous inflation. So if you took paper currency to the marketplace to buy a roll of toilet paper, you'd be better off not buying the toilet paper and using the paper money for something else, okay? That's what's very bad. So what happens? Countries have to revalue their currency. They start over again with a new currency, okay? And there's a country in which I have the currency at my home. I was a trillionaire, okay, because I had a $1 trillion note, but it was essentially worth a couple pennies because the inflation was so bad. So what you do is you cut off all the zeros and issue a new currency if inflation is too bad. We don't want that to happen in this country, and it's not. It hasn't happened in this country. So where are interest rates headed? Notice the Fed, 1979, 1980, raised interest rates a lot. What happened? Threw the economy into recession, short term, to bring down inflation. It turns out now what's happening, the Federal Reserve is raising interest rates and trying to do the same, following in the footsteps of Paul Volcker, the then chairman of the Federal Reserve. And as I said, I think the Fed's doing too much, okay, too quickly. And we're likely headed for a recession. When? In 2023, next year. I'm not so sure that the 8 economists declared we were in a recession. Therefore, I'm looking ahead and saying in the first part of 2023, I expect us to be in a recession. I put the probability at 60-80%. I don't want to say 67.25, okay? You probably wouldn't believe me anyway. But 60 to 80% will be in a recession. Does everybody agree with me? No. Would President Biden say, Jim, come to Washington, we need you? I want you to say that, okay, that we're headed for a recession. No, of course not. But economists do disagree. You've heard they're saying we want a one-armed economist because on the one hand, then on the other hand, you know, they have two views about most things. But no, I do think we're headed for a recession. 100% sure? No. Nobody should say 100%, but highly likely. So here's our recessions. We started dating recessions in 1854, okay? And it turns out we've had 34 recessions in 178 years. And that's a factual statement. You can check it. Maybe I'm off by a year or two. But from 1854 to 2022, 34 recessions, one every 5 years. So I can say on average, if we have a recession in 2023, it will come out of it, but 5 years later we'll have another recession. It turns out the average length of a recession, 17 months from 1854 to 2022. So about a year and a half, then we finish with a recession, then we have an expansionary period, which would be good for us. In the late 1870s, we had the longest recession. The second longest was during the Great Depression, which we all know about. The unemployment rate got to about 25%. In the most recent recession, 2020, it got to about 14%, okay, the unemployment rate. So what's the shortest? I already told you, February 2020 to April 2020, 2 months, the shortest in the history of this country. I expect the next recession in 2023, if I'm right, to be relatively short, not overly severe, and certainly not anywhere near what happened in 2020 with the health crisis, COVID-19, or is certainly nowhere near as bad in 2020. The banks are far better shape, better capitalized, so on and so forth, and I don't expect the housing boom and bust that we had in 2007, 2008. I don't expect to bail out of the banks, those sorts of things, if we do have a recession in 2023. Now, let me turn to home prices. Second topic, what do I see with respect to home prices? Here's the composition of wealth. If you go to the super rich, you can see only 8% of the wealth is in terms of the home that they live in. So super wealth don't have to worry about increases or decreases in home prices. That doesn't affect the wealth. Jeff Bezos, Elon Musk, Jim Barth has to worry, okay? You notice the three different names, categories of, you haven't heard about my wealth, right? You won't, okay? It turns out, then you say upper income, it's 1/4 of their wealth. So they don't have to worry if home prices go up a lot or they go down a lot. That's not a major component of wealth. But what about middle income? It's 2/3 of their wealth. Those are the people we have to worry about if they have a home. And many of those people, they only have one home, not several homes, located in different parts of the United States or other countries. So they don't even diversify their home wealth. It's a single home. And older people we have to worry about they may build up a lot of equity, but if they lose that equity very quickly, some may want to move to the south, a warmer climate, downsize, but they sometimes can't downsize if the home value falls too much, because maybe they can't move someplace and take the equity out of their home, sell it, because where they would want to go, maybe the home price is too high. So they are living the rest of their lives like in a city like Detroit. You have to be sorry for those people if they're older and the home isn't worth very much. Some homes in Detroit were selling for less than the price of an automobile. So the people couldn't perhaps go to Florida, sunnier climate. They just have to stay in the home because the home price, the value has declined so much. And then if you go to lower income people, many can't even afford to buy a home. And as you know, rent prices are up now. So those people are really in trouble when it comes to trying to build wealth. So then we look, what about home prices? Look at Seattle, okay? It's fine as long as home prices stay up, but then first-time home buyers aren't going to say, let's move to California and buy a home. That's where the median home price is the highest in the country. California, looking at statewide data, okay, over 500,000. How many of you are saying, gee, I'm going to go there and buy a home today? Home prices are likely to be going down, and they are already throughout most of the metropolitan areas in our country today. So look at Alabama, okay, less than $200,000. So if you want to buy a cheaper priced home, come to Alabama, okay? Join me, become a neighbor. But it turns out you can buy more home space for less money, than you can maybe in the great state of Washington. Maybe the dean would agree with me, okay? But we can't lure him to Alabama, he's likes Seattle so much, okay? It turns out other parts of the country, they're lighter blue, where home prices are low. And you get some people move it in part because of what? Working from home. You start to say, where should I want to work? Do I want to work in a high-priced neighborhood if I'm a first-time home buyer? Maybe I want to go someplace else. And this is the change in home prices. From 1900 to today, home prices have declined in just over 50% of the years. What does that tell you? If you assume home prices only go up, you're not going to be right. You don't just buy a home and assume the home price is always going to go up. 50% of the time you're going to be wrong if you view it as an investment, okay? Home prices go down half the time. And they go down sometimes a lot. But for 10 years, on average, home prices have gone up. Good news if you own a home. But if you're a first-time home buyer, you say, just a second now, when's the crash going to occur? Then I can be happy, okay? Old people like it. If they've been living in a home a long time, they see all that equity built up. What does that mean? And their home, they may pay off the mortgage. But for younger people, they want to borrow money. And they may not be able to borrow enough money to make the down payment required. So we've had a run of 10 years or so, increases in home prices, but when they go up, they always typically are followed by declines. And when they decline, we typically end up in a recession. Okay, not always, but typically. If you look around the world, okay, and you look where there have been crises, the common denominator for explaining declines in economic activity is a decline in home prices, okay? The most common denominator, not the only factor, but an important factor. So we go, what about mortgage rates? Did they go up a lot in 1980? Sure. Why? Because the Fed raised interest rates. Did people want to buy homes? Could poorer people, lower middle income people buy homes? No, couldn't afford the interest rate. And there's a difference, which I don't go to, adjustable and fixed rate mortgages, things like that, mortgage-backed securities, private label securitization, which I don't go to. But see, rates came down a lot, and they came down quite a bit. Now they're going back up. Why? Because of Chairman Powell, okay? Your friend, okay? Or maybe not your friend, because he's raising rates a lot, substantial lot, very, very fast. It turns out they go up. So the home mortgage rate on a 30-year mortgage now, just over 7%. If you're going to buy, and that's more than double what they were earlier this year, okay? More than double. If you wanted to buy, at the current interest rate, if you wanted to buy a home that was $400,000, less than the median home price in Seattle or the state of Washington, it turns out now you can only afford to buy a $300,000 home. It lost $1,000 in the value of the home. What can you buy in some places for $300,000? Come to Alabama, okay? Here's negative equity, okay? That just means the mortgage is greater than the value of your home. During the home price boom and bust, which some of you may not have been around, okay, but it turns out then we had a lot of negative equity, meaning a lot of people owed more than the value of the home. So what did they do? They defaulted on their mortgages. And we called a lot of the people subprime borrowers, pejorative sort of term, meaning they weren't prime borrowers, they weren't distinguished because they were subprime borrowers. Lower income, people are more likely to default on the mortgage than prime borrowers. And some people never default, don't have to because they pay cash, okay? You know, those are the super rich, effectively, probably don't even, well, I don't want to say they don't know what a mortgage is, but they don't have to worry about a mortgage. But it turns out, you can see here, not too bad compared to 2007, 2008. Things were really bad at that particular point in time. We had the Great Recession, December 2007 to the summer 2009, the worst recession, okay, since the Great Depression in the 1930s. That's why it's called the Great Recession in contrast to the Great Depression. And it was worldwide, global financial crisis, other countries, those sorts of things. So you see basically there are a couple states, they are dark red. That just means those people in that category, 5% or so, means their home is worth less than the mortgage they owe. So what would you do? Would you walk away from your home, turn the keys over to the lender, to the bank? You're saying no. She's saying no. And the dean said, oh, yes. Oh, no, I'm sorry. I didn't mean to say that, Dean, okay? No, but a lot of people say it becomes an ethical question. Do you walk away from your mortgage? If the mortgage exceeds the value of your home, is that the ethical thing to do? Or is it the financial thing to do? What are you taught in the business school? What do your finance professors, economists teach you? Walk away. It's an economic decision. Or does it become a moral, ethical sort of issue? If you can pay. Some people can't pay and they have no choice but to walk away, basically turn over the keys. And then you have some firms, BlackRock, you've heard about some firms buying up homes, right? At low prices and renting them out at high rent prices, those sorts of things. So here, where do you plan to live? Some people are moving away from states where home prices are very high and moving to other states, okay? People are leaving California, and you see, especially New York and New Jersey. Has anybody been to New Jersey? And then you left. You have to pump your own gas in New Jersey, right? Did you know that? It's good exercise, I guess, getting out of your car when it's raining and snowing and that, and stand there by pumping the gas in your car. Unless you have a what? Electric vehicle? I guess then maybe you do something else.
We have our own gas here too.
Oh, you do?
Yeah.
Oh, I didn't know that. Okay. And when I go to New Jersey, I'll tell them, you're not alone, okay? Go to Washington, you'll feel at home, okay? If you can afford the home prices. I didn't know. So this is a state in which you have to pump your own gas? No, I didn't know that. Okay, Alabama, people come out and run out. Oh, how are you? Would you like coffee? Starbucks, of course, or something like that. It turns out, though, you can see some people want to leave Texas. Some people want to leave Florida. But the net migration is positive into Texas and into Florida. And you know who moved to Austin, don't you?
Yes.
Yeah, Elon Musk, okay? Did he drive an electric car there, a Tesla or anything? Well, if you leave Los Angeles and go to Austin, the home price in Austin is about half the median home price in Los Angeles. So some people move in that direction. I don't think Elon Musk made a decision based on the price of a home. You probably don't either, or the price of a Tesla, okay, or a gasoline automobile. But it turns out also, if you want to move up in Los Angeles, upgrade your home, the upgrade price is about $1 million. It's only about $500,000 in Austin. See, so a lot of people go there. Why? Because of COVID-19, perhaps. Working from home, you can move there. I have former students. One, she's in Cleveland, Ohio. Where does her husband work? For Meta, okay, Facebook. So a lot of people now work in all parts of the country, if not sometimes in other countries, because they're working from home now rather than in the office. So it says something about office retail space and the value. Now, here's something just for your amusement or entertainment. There's 3 different figures there. It turns out 1 square footage of a house, which has gone up a lot, the square footage of homes. And the other is the square footage per person, okay? And the other is the number of people per household. So the one with the negative slope going down is the number of people per household. It's going down. But the square footage per person is doing what? Going up. That tells you the magnitude of the obesity problem in the United States, okay? People need much more space. Is that what's happening? Cause and effect, which you're taught, in business analytics sort of course, not just causation, but cause and effect. Now, do you think your grandparents were worse off then than today? Okay, you would be because they had so little square footage? Well, what I conclude, we're putting a lot of money into what? Home size, and perhaps some of that money or those resources could have been devoted more to what? Education and health. Okay, what is more important? If I showed you the same sort of information for people living, for example, in Hong Kong and some Asian countries, you'd find just the opposite. Less square footage per person, more money put into education and health. What should we be investing in? Home size or people? Through making them healthier and making them more educated, giving them the skills they need in a modern economy. Okay, federal budgets and deficits, and I'll come back to the last point in a few minutes. This is the history from 1790 to today in terms of federal budgets and deficits. A deficit occurs when federal spending exceeds federal receipts. All with me? If the federal government spends less than it takes in taxes, for example, we say there's a surplus. If the federal government takes it exactly what it and spends exactly what it takes in, okay, we call that a balanced budget or a miracle, right? Okay, it doesn't do that at all very often. So when have most of our recessions occurred, and during what periods of time? Historically, until recently, during wars and recessions. But after every recession and war, typically what happens to the deficit? It turns to a surplus, it becomes very small, and the debt becomes a lot smaller relative to the GDP. You always have to scale the deficits or surpluses or the federal government debt by GDP. Now, if I want to attack President Bush some years ago, or I want to attack today President Biden, I'd say, look at his deficit. It's gigantic. Of course it is, compared to George Washington, our first president. But President Trump had a big deficit, or big debt in absolute terms. So you always want to scale these things, okay? The same with population, different countries, GDP per capita rather than just GDP, okay? US, China has arguably roughly the same size GDP as the US in real terms. Whether it be exchange basis, calculated or purchasing power parity calculated. But the U.S. has a much higher GDP per capita, okay, than China. So China has big GDP, but a lot of people, okay, compared to the United States. 330 million people in the United States, 1.2, 1.3 billion in China. India is almost as big, but a much smaller GDP than even China, okay? But in any event, so it comes on. But now we're not seeing a decline in the debt to GDP ratio. And we're seeing a deficit that's growing. So do we really care? Well, this is 2021, the most recent figures that are available. We had a deficit in 2021, $2.8 trillion. That's even real money to people like Jeff Bezos and Elon Musk, right? Billionaires, not trillionaires, okay? And notice the deficit was 12.4% of GDP. Over the past 50 years, what was the average deficit to GDP? 3.5%. Unprecedented. What about the debt to GDP? 100% of publicly held debt is 100% of GDP today, or in 2021. What was it on average over the past 45%? We're in, they use this phrase, uncharted territory. That just means we have no idea where we're headed. But we have to take corrective measures, okay? It's getting too high. And what are interest rates doing? Well, it turns out, notice there, 2020, okay, when you go back, that's when we had COVID-19. A big shock, shut down, and you got a lot of spending. Maybe too much spending, and not all spent on what it was targeted to be spent on. And then we did run a surplus for a short time, okay, unusual, okay, but a short time. There's a little story about that, but I won't go into that now, okay. But typically, we do run deficit, but they're not too large relative to GDP. Now, they're expected to get bigger, according to the Congressional Budget Office and even the administration, unless there's some, things done that may not turn out to be quite correct. Okay, this is the debt to GDP ratio. It's going above, or projected to go above, what it was in World War II. What did I say? After a war, what happens to the debt to GDP ratio? It goes down. It's going up. And we're not technically, and this is again, are we in a war or not? Are we in war with Russia? I have no particular expertise compared to you to say whether we're in a war or not. There's a conflict between Ukraine and Russia, and we're supplying some arms to one side, not the other, and that creates a whole set of problems. But if we're not in a war, not in a recession, now, then you say, why is the debt to GDP ratio coming in? It's expected to go up. And now, what is happening to interest rates? Well, interest rates are going up, and you can see here we have net interest. Higher interest rates mean what? More interest payments. And our discretionary spending is a small portion of the budget, okay? There isn't a lot of room to cut a lot out of the budget. So what do? If you're young, you may be paying into Social Security if you're working, and you would like to get back what you put in. But older people don't want you to get that back. Not in reality, but because we can't afford, basically, and you are going to get a negative return on what you put into Social Security, okay? That is, you'll never get back all that you put in over time. And in my view, probably, given life expectancies are going up, and they have gone up since we established Social Security in the 1930s, we should require you to not be able to collect any Social Security until you're 90 years old and continue working until you're 90. Judy likes that, right? Yeah, why not, okay? No, but if you're young, you say, just a second now. We want to get back what we put in, but you're not concerned about it now, but eventually there will have to be adjustments made with respect to some of the so-called mandatory spending programs. Mandatory means by law, we're supposed to engage in that type of spending. Discretion means we could cut that spending. We could cut defense spending, for example, cut it in half, eliminate all defense spending. I'm not advocating that, okay? This is not a quote, okay? And I won't even attribute it to the dean, okay? It turns out, what about cryptocurrencies? Another topic that everybody's talking about. One of the professors, we were chatting, and he was telling me about some of his investments. I tried to get him to tell me how much he was up or how much he was down. A saddened look came over his face, and he demurred. I said, let's not talk about cryptocurrencies now. You talk later tonight, okay? Cryptocurrencies, interesting. A challenge and an opportunity. If you're young, incidentally, one thing remember, if you're young, you can afford to lose money now. If you're older, you can't afford to lose as much, if anything at all. So there is a difference. You're always taught in a finance course, as you get closer to retirement, put more of your wealth into what? Less risky assets. If you're younger, bet everything. Bet on black or red or whatever, okay? But it turns out, and there's some sense to that because you have less to lose and more years to do what? Get back, what you lost. And I've showed you that. Over time, recessions are what? Temporary. They're not permanent. The 100 Years' War was a long time. You wouldn't have, been alive when it ended, perhaps. But today you can always get it back. So dabbling in cryptocurrencies, why not if you're young? Don't just take your parents' life savings and say, here, I learned a lot in my finance course, okay? Mom and Dad, okay, give me everything. I'll double or triple what you have for your retirement. You may lose not only money for them, but your inheritance, okay, if there's any. So again, you have to be careful the older you are. And there's a famous Nobel Prize-winning finance professor. They once asked him, how do you allocate your retirement funds? Do you change from stocks to bonds over time? And he's very famous. And he was honest. He said, ever since I got a job, I put 50% in stocks, 50% in bonds. But you're a Nobel Prize winner. Can't you do better than just 50% each one? He said, no. I've done that my entire career. Famous professors. See, so even sometimes the smartest people teach one thing and don't do exactly what they teach, perhaps. Okay, so there are three participants I'll talk about Bitcoin, but a lot of what I say applies to others. There are users of cryptocurrencies. There are what are called miners of cryptocurrencies, not unlike miners of gold, okay? And there's an analogy I'll mention. And then there's the blockchain. So who are the users? They're the individuals who have a so-called wallet. How many of you, incidentally, have invested in Bitcoin? Any of you? Are these the losers in our group? No, I mean the winners. Okay, a few of you. Okay, so you have a wallet. She has a wallet here filled with Bitcoins. Thousands of Bitcoins, right? Not quite. And you bought years ago, 10 years ago, 1 month ago, when it was 60,000? No, but it turns out you have users and they have a wallet and you see they have a public key and a private key or password. And everything's anonymous, right? You just identified yourself. There is an IRS agent in the back of the room, okay? He took a photo. I said, see him walking there at that camera? He was waiting for this segment, okay? Identify all the cryptocurrency investors. No, he's not with IRS, okay? But I will turn you in anyway for a reward. Now, it turns out, and everything's anonymous, meaning you can engage in illegal transactions. Illegal transaction, does that ring a bell? No, okay. It turns out they're miners. Who are they, the miners? What they do is they process and verify transactions. That's the miners, okay, to make it simple. And basically, what they do is they get a reward. They solve complex algorithms, okay, using computers, and the computers use up a lot of energy. And by doing that, whoever solves the problem first, and they get ever more complicated, they get this reward in Bitcoins. And the higher the price of Bitcoins, the more miners, the more the incentive to solve these problems, okay? And then you can see the reward declines over time until eventually in 2040, there's no more reward, okay, for mining Bitcoins. But they get a fee for mining, for servicing transactions, processing, and recording all the transactions, verifying them. Then you see the final Bitcoin is to be mined in 2040. And there'll be, at that time, no more Bitcoins that could be mined. 21 million Bitcoins, the maximum number that could be mined. Just like gold, a finite amount of gold in planet Earth, you mine it all, it's all gone. It's still there. Okay, that's the analogy to miners, people mining gold. And then you see the blockchain, originally chains of blocks, okay, of transactions to be, but now they're called distributed ledgers, no longer blocks. And inside that term, blockchain was not used in the original white paper talking about Bitcoin. Not used, but they call it distributed ledgers, democratization of money, you might say. And then you can see here, everyone that belongs to the blockchain has Bitcoin, can access all the transactions, determine all the transactions that occurred from the history. Now, the blockchain has taken on a life of its own. It doesn't have to be associated with cryptocurrencies. It could be associated with a university. MIT, okay, has one. And anyone can determine whether or not somebody says they have a degree from MIT. You can verify it going to the blockchain because it's been verified. And you can tell who did receive a degree from a university, what year, so on and so forth. So everything's on the blockchain. That's why you can separate the blockchain. It doesn't have to be a private blockchain. It can be a public blockchain like Bitcoin, or you can use it without being connected to a cryptocurrency. So that just remember, there's just three participants: users, miners, and then the blockchain, which is where all the transactions are stored over time. Then we have current information on Bitcoin, and I updated this about a week or two ago. So you have over 19 million Bitcoins. How many can be minted or mined? 21 million. We're getting close. And then how many left to be mined? Okay. I doubt that we have any miners here. Okay. China had miners in China, and they were using up so much energy. China told all miners, get out of China, okay? And they all had to leave China. And some came to Alabama, Georgia, Texas, states here in the United States because we still allow them. And Wyoming wants to be the Bitcoin capital of the world. Okay, what else is in Wyoming? I don't want to sound negative about Wyoming, okay? But they wanted great jobs. So some states decided, let's welcome the new technology, okay? And then you see 91% of the Bitcoins have been mined and new Bitcoins per day. And the number fluctuates depending on the price of Bitcoin. And I noticed today, okay, it's 20-some thousand. The high, I'll show you. Now, see, you should have bought in 2013, okay, right? Your parents would be proud of you, okay, happy with you. And they'd say, we don't have to give you any money anymore. Give us money, please, okay? But maybe it'll go back up in 100 years, maybe sooner, okay? But notice the fluctuation. That's the time to have bought, okay? And of course, your finance professors give you all the information on what to buy and when to buy, right? If you're a student here, okay? No. I don't know. Nobody knows for sure. And that was one thing, okay? As I told you, it's around 20-some thousand. One of my former students was telling me, Jim, buy Bitcoin. When it was 19,000. And I said, why should I buy more Bitcoin? At 19,000, he said, it's going to go to 100,000. And he works for a famous investment company. And he said, I assure you. I said, why do you say you assure me? He said, that's what my colleagues tell me. And we make a lot of money for people. And I said, oh, it's going to go to 100,000? When it was going up to 60,000, see, I told you. I didn't buy. And he said, I told you. Buy at 19,000, it's 60,000. It's going to, I said, would you still want me to say? He said, yes, it's going to 100,000. I promise you. I said, write that down. Okay. And he said, well, I don't have a pen. Okay. I said, no, put it in an email. With your signature. Even electronic signature is legally bound. No, he didn't do that. But it went back down to, it hasn't gone below 19,000, which is when he told me. I was waiting, it got to 19,000, but not below. Okay, but he didn't tell me to buy it $13 or $100, okay? Then it wasn't so good. Now, Miami, there's a company called Citicoin, and Miami decided to adopt a cryptocurrency. And when was it launched? August 2021. What was said on November 11, 2020, Mayor Suez said Miami would give a Bitcoin yield from Miami coin as dividend to residents. Don't you wish you were in Miami? Okay, you're probably saying, why didn't I move to Miami? Okay, Mayor Suez expressed hope that at one point down the road, his city could run without taxes. Great idea, right? In November, Mayor Suez tweeted he would take his next paycheck 100% in Bitcoin, paying government employees in Bitcoin was his top priority. Mayor says, well, do you think he's saying that today? Or he did? There's the Miami coin. Notice August, okay, in September, what was pretty high. Would you want to have been paid as an employee in Miami coin? Do you think you would trust him to forecast the future of Miami coin or anything else? See, sometimes people are overly optimistic, okay? So it's nice to be an optimist. You don't want to go through life and people ask you, where are we headed in a recession? I'm depressed every day. So I want to be an optimist. I don't want to, what do you want to do today? I don't know. We're headed to a recession. I don't know what to do. No, I like to be an optimist, but you also have to be blend optimism with realism, okay? He was overly optimistic, you might say. There are probably other terms you could use. Okay, how many cryptocurrencies are there in the world today? Approximately 21,000, just over 21,000. I should identify the professor I was talking to. He bought a portfolio of Bitcoins, not 21,000. You don't own 21,000, do you? Not yet, okay? It turns out only 49 cryptocurrencies have a market value greater than $1 billion. So Elon Musk, $1 billion is what? A small portion of his wealth? What did he pay for Twitter? $44 billion? He could have bought some Bitcoins, okay? Or other cryptocurrencies. And then Bitcoin's market value is 40% of the value of all cryptocurrencies. See, and it's, what is it? 372 billion, and then Ethereum, okay, is 160 billion. Not all that much. 81 million people around the world have created unique big blockchain wallets, and more than 1,900 cryptocurrencies have already failed, okay? And there's a lot of fraud associated with Bitcoin. Now, you say, if you take all this, okay, under $1 trillion, the bank deposits in all the banks, we have about 4,500 banks in the United States today. They have about 21 trillion in deposits. That's just banks, okay? See, and that's just the United States. So worldwide, $1 trillion is next to nothing. To us, it's a lot, but worldwide, okay, you're talking about hundreds of trillions of dollars in wealth. See, so it doesn't register. We don't have to worry about a cryptocurrency sort of collapse affecting the financial sector in the United States or other countries or the worldwide financial system. That's the good news, okay, with what's happening. Our cryptocurrency money, they're not legal tender. Legal tender means it must be accepted in exchange for goods and services. A country deems that to be legal tender. Is there gold or silver backing our currency in the United States? Yes or no? Do we have gold backing the US dollar? No? Who taught you? No, we don't, okay? It turns out no gold backing. At one time, yes. Silver one time, coins not. Legal tender is a small portion of our money supply. And the money supply, since the summer, has been declining at a negative rate, okay? And some people or monitors might say, oh, gee, that bodes ill well for what's going to happen to our economy. And they say that's why we're going to head to a recession, too. So money, unit of account. Can you use cryptocurrency everywhere? Is it everything said, oh, you go into a store, you pay your tuition here in cryptocurrency? No. See, you can't do that. You pay in dollars. See, so it's not everything is priced in a store in a cryptocurrency. So it's not a unit of account. Most places. Can you use it everywhere? Starbucks? No. Okay. Some places, yes, but not everywhere. I saw there's I think a Bitcoin ATM near the hotel. Okay. I didn't go there, but I just noticed you have ATMs. Store value, is the price stable of Bitcoin? No. See, so it doesn't satisfy the three basic characteristics of money, so it's not money in my view. And SEC says it's an investment. Okay, there can be regulated by the SEC or the Commodity Futures Exchange Commission, and you can be taxed if the price goes up and you sell a cryptocurrency, if they can catch you. And bank deposits, unit of account, yes. Minimum exchange, yes. Store value, yes. And they're insured. So one thing, cryptocurrencies are not insured. You lose money, you lose it. A bank, the bank fails. We have a deposit insurance fund called the FDIC, which is required, which is backed by the federal government. So you never lose your money if it's in an insured deposit account, depending on the amount in that. And then cryptocurrencies, not really unit of account, medium exchange, store value. So not really money, and nothing's insured. Okay. And we used to have you heard of Celsius? Anybody in the cryptocurrency world? Celsius? It's a bank, effectively, that was a bank for cryptocurrency users. It filed for bankruptcy, okay? And they're paying interest rates close to 20% on all your deposits. But eventually, some people may end up losing money, okay? It turns out New York and Texas are winning the war to attract miners, okay? Very small towns they go into, a massive number of computers to solve problems. With Bitcoin, it's called proof of work, okay? Ethereum came out with what's called merge, and it's a proof of stake, and far less dependent upon the use of energy. And China threw out the miners because of the use of energy, okay? But Ethereum created this merge, and now less dependent upon energy, okay? And we have, I remember I gave a talk in Georgia, and they're setting up mining companies. In Alabama, they set up mining companies. And I remember going to California, Oakland, they wanted to set up a cannabis bank. And they're public banks. And the cannabis growers were being robbed all the time. So they couldn't, the federal government said you can't deposit your cash into state chartered or federally chartered banks. So they set up cannabis banks. There are a lot of public banks that you may not know about throughout our country, and a lot of cities and states have what are called public banks, moving to a greater degree than you might realize. Raises an issue. Should the cities do it? Should the states do it? Will the federal government get involved or not? The same with fintech companies, which I won't go into. Now, China has created its own digital currency. The People's Bank of China, its central bank, has created a digital currency. And it's being used in China, throughout parts of China. So China's moving ahead of the United States with creating a central bank digital currency, which would be like legal tender. Bahamas has also a cryptocurrency, sand dollars they're called, okay? And El Salvador adopted Bitcoin as legal tender, not being used now because of the price and people wary of it. So the last one I'm going to mention, since I'm over my time, is I think the most important for younger people, where we have to do. This is the fading American dream, okay? The percent of children earning more than their parents by year of birth, okay? So 90%, when you go back in time in 1940, 90% of children earn more than their parents. But today it's down to just over 50%. So children are not likely in some parts of this country to earn more than their parents. So we're losing that American dream, which parents want their children to more than the parents, okay? And this, in the Southeast, there's a heavier proportion of the population that's African American, minorities, okay? And the children there, because of where they're born, and they say they're less likely to earn more than their parents. You're okay in Washington, Seattle, and look at the Bay Area, 37,000. You earn more than your parents if your children born there. So where you're born has an impact on your future income relative to the income of your parents. And so it's the people you're around, okay, compared to others, okay? The connection you make, the school, classmates, things like that, which is sort of amazing. Then we look and we say, where do the patents come from? You see here, patent rates per 1,000 children located by where they grow up. Look at San Francisco, San Jose, 5.4 patents. And look at when you go into the Southeast, children typically are not responsible for creating any patents. So where you're born out can determine your future economic outcome and also the outcome for society, okay, has a lot to do to where you grew up. Now, you don't say, gee, your parents, you're born in Alabama and your parents send you to San Jose and say, good, you're going to become wealthy, okay, you earn more weed. It doesn't work quite that way. It's like life expectancy is greater in Japan, the US, by about, I think it's 8 years or so. So as I get older, I say, when do I buy my ticket to Tokyo, okay, and gain another 8 years of my life, okay? It doesn't work quite that way. Japanese who move to San Francisco, their life expectancy go down, incidentally, not up. It's your culture, what you eat, things like that. It turns out human capital, the World Bank has a human capital index. Some countries are high. If you're born in Chad, do you have a lot of human capital? Are you going to earn a lot? If you're born in Papua New Guinea, do you want to move there and get your education? See, children have no choice, basically. They're born into a family in a particular geographical location, someplace on planet Earth. They have no choice. Their parents perhaps have some choice, but less so for parents in lower incomes than the super rich, as you might expect, and I think you can agree with me. But look at Pakistan, okay? Look at the US. Countries have more human capital measured by this, and it's health and education. So quickly, human capital versus GDP growth per capita. They're positively correlated. It makes sense. So build human capital and you get economic growth. The same with immigrants into this country. And I'm not talking about the border illegal issue. A lot of immigrants create a lot of jobs in this country. If you look at some kind of where people come from, they contribute a lot to the American economy, economic growth, create jobs for all sorts of people from all backgrounds, from all parts of the planet Earth. So again, you want to encourage the buildup of human capital, and that includes some people come here and add to human capital, add to our economic growth, which I talked about with the first point. What did James Heckman, a Nobel Prize winner, professor at the University of Chicago, say? At age 5, he can determine he's a gifted econometrician that focuses on human capital. He can tell roughly with uncanny accuracy the likelihood of a child at age 5 whether they'll ever graduate from college at age 5. The learning process starts before age 5. Don't say, I'm sorry, it's too late, I'm dropping out of college. That's not the message, okay? And don't go after your parents and say, what did you do in my first 5 years? Okay? Don't do that either, okay? It means if you have children, start early, okay? And education is an ongoing process. I still learn every day I'm alive, every day. I look around, talk to people, and learn from all sorts of people. Less educated, some more educated I learn less from than less educated, okay? It's not just formal education. A lot, so that tells you start early on and look at the education demand for jobs. You can see 72%, when you go back in time, 1973, you didn't need a college degree or high school degree, okay? Then what happened today? About half of the same percentage of people, okay, now are less in demand because they don't have the skills. So we have a skills shortage. It's human capital, the skills that you require. And sometimes we know some people have a lot of formal education, and you say, how in the world did they get this job? Okay, so not just formal education, it's a variety of educational type skills Okay, I've met a few colleagues in my business school, and I wondered, gee, this person has a PhD. Where's common sense enter the equation? Okay, we see that here and there. I miss things in that. Now, let me give you the important. So, human capital is the name of the game, but we don't in business schools. No offense, okay, to Dean Phillips or anybody else. It's nationwide. We're changing and saying we don't want to just teach invest in stocks and bonds or cryptocurrency or gold. Invest in people. Okay, and that's where the payoffs are great. The younger, the bigger the payoff, okay, that you get. It's people that make the difference. It's not the buildings. It's not the infrastructure, okay? It's the people we should talk about. But my colleagues, I say, I actually in my undergraduate talk about investing in people. I have a section on health. I have a section on education. I have a section on energy. I have for years, okay? And I occasionally ask my colleagues, do you talk about investing in people? Oh, Jim, it's all about stocks and bonds. Where do the people enter? That's the highest return you get from investing in people, not stocks and bonds. So what about Singapore? 1960 compared to Jamaica. If you go to Jamaica, okay, I've actually been to the capital of Jamaica. It is different from the resort area, which I haven't been to. But what was per capita income 1960? About the same in Singapore and Jamaica. Okay, Dr. Ben Yao is from Singapore. Okay, I've been to Singapore. Lovely island, sort of city-state. It turns out Singapore had the same per capita income. They're roughly the same size, same natural resources. Singapore does have mines. When you go back to the 69, Africa was the wealthiest place on planet Earth. And why do you think China's interested in Africa? All sorts of natural resources. What are they lacking? Human capital. Okay, that's it. Otherwise, it'd be once again, one of the wealthiest places on planet Earth. So what happened to Singapore? What happened to Jamaica? Do you think it has to do with natural resources, manufacturing, globalization? People make the difference, okay? That's the difference between Singapore and Jamaica. And one last slide, okay, then I won't keep you anymore, which is Ireland and Trinidad. Anybody been to Trinidad or Ireland? Anybody been to Ireland?
Yes.
Yeah, Ireland. You went to the beers places, right? Yeah, obviously. Okay. You could go to. It's like going to Australia. Okay. They say there's a beer place on every corner or something, which is somewhat true, I guess. But during the day, okay. I think near my hotel there's a beer garden or something. I think where you probably go and spend your bitcoins, right? No, not at all. It turns out 1960, look at per capita income. Not that different, right? What made the difference between Ireland's growth, okay, per capita, and Trinidad's? A big difference. People made the difference. It isn't just the cryptocurrencies, one found it, one did not. Nakamoto, instead, the anonymous person who founded Bitcoin, or a group of people, owns a lot of Bitcoins. I don't know what's happening if they dumped them into the marketplace, if that would sink the price. Forgot to mention that. But here, it's people, basically. So it's ultimately people, and what the younger people in this room are going to make the difference, okay? Sometime in the future, and you never know which of your classmates or which young person is going to come up with a way to cure some disease and that. That's the advantage of inclusion, having everybody participate, because you never know which person you may want to be your doctor when you have a serious medical problem. Nobody cares what the person looks like, what their background or anything else. You want the best. See, so everybody, and the more people that participate, the greater the opportunity that somebody's going to find a cure for disease or a way to grow economies or improve human capital. See, that's the benefit of inclusion, ultimately, is to let everybody have equal opportunity. And once they do, you may have a better chance of more people developing a better way to make it a better place on planet Earth. That's why I say this last topic is the most important. To emphasize human capital, people basically, not just buildings, cars, all those sorts of things, not just energy, but the energy coming from people and more people giving an opportunity to contribute to in important sorts of ways. Right, Judy? Okay, absolutely. So I got an agreement, okay? I have to be nice to her, okay? Otherwise, she won't be nice to me. Okay, I've kept you longer than I'm supposed to. I only had an hour, but I thought the 5 topics were pretty important. Alicia was the one who helped me pick. I gave 10 topics I could talk about. She said, Jim, you can't cover all 10. So she picked 5 of the topics. I hope you enjoyed them, learned a little bit, hopefully, and think through these sort of issues and build your human capital. And if you have children, start young with them, okay? Thank you so much for giving me the opportunity to talk to you. Now, Dean, I apologize. I got some questions. The Dean got questions, and I'm sorry I didn't give you much time to ask questions, so it's up to you.
But believe it or not, I agree with you on most of your views, and 2 economists are never supposed to agree, so there you go. Yeah, we're a little bit late, so we're going to have a lightning round of questions, right? So I'm going to paraphrase a question we got, and you're going to quickly give me a 30-second answer, okay? So the first question was, given some of the challenges we faced with supply chain due to globalization, due to some of the political, economic, geopolitical pressures that we've been facing, you see some companies rethinking outsourcing overseas and so forth. Do you see the general trend towards globalization breaking up a bit as a result of what we've seen the last 2 years, or is it just going to be a hiccup and we're going to get back to more and more globalization?
Thank you. I talk in my class a little bit about we're moving away from globalization towards nationalization. Countries trying to believe they can produce almost everything they need within their own borders, being less dependent upon trade. And we see that today. We see what's happening with Russia and Europe, having been dependent upon oil, natural gas from Russia. And so the U.S. is rethinking things with respect to globalization versus nationalization. I think it's happening in a lot of different countries. I think it's a shame because we were taught by Anderson years ago, basically 1776, effectively, a long time ago, that globalization can be beneficial. There's gains from trade across national borders.
Great, thank you. Next question. You mentioned that you were able to pull your money out of the stock market before the recent decline, right? Question is, where'd you put it? Cash, bonds, commodities, where? Where can you hide?
I gave it to my wife.
Great. All right. Last question then. You talked a lot about the problem of inflation. If we were to eliminate the tariffs that were imposed on China by the Trump administration, would that help? Would that help with our inflation problems?
Right now, part of our growth in the third quarter was due to net imports, basically being negative. That is, we're exporting more than we're importing. I think that's going to reverse itself because of the strong dollar. It'd be great if we got along much better with China, given China is so important today. It's a very important country, as is India, incidentally. India and China, 2 biggest countries in terms of population, to 2 with the biggest potential over time to grow and prosper. We should get along with these countries, both India and China, in my view.
Great. I'm happy to let you know you passed the lightning round. You were 3 for 3. Congratulations. Seriously, let's give another round of applause to Dr. Barth, and thank you for being here.
Thank you. Thank you. Thank you, sir.